A high monthly dividend income, low volatility, low risk of losing your capital, a moderate growth in your principal amount as comparable to the S&P 500. Does that sound too good to be true? JEPI is a covered call ETF that promises all that. What is going on, investors? Welcome to the channel. This is the Frugal Investor. In this video, I will go deep into what is JEPI and how it promises the monthly income that it promises, which is a 7% dividend yield as of today. Before we get started, please press the like and subscribe button right now. With that said, let's get right into it. Let's go over a brief overview of what is JEPI. JEPI is a covered call ETF that promises a high monthly paid out dividend income that they generate from covered call options and buying dividend paying stocks. The goal of this ETF is to provide current monthly income while maintaining prospects for capital appreciation as comparable to the S&P 500. Not only will your principal grow as comparable to the S&P 500, but you will also get monthly dividend income. This ETF is owned by JP Morgan and Chase. This is an actively managed ETF that is portfolio managers with a lot of experience on their resume are managing this ETF for you. Currently, the two portfolio managers that are managing this ETF for you have been in the industry for over 30 years, so they have a lot of experience. This fund, it just started in May 2020, so it is a very new fund. Previously, this option was only available for JP Morgan's elite clients as in people who have more than $10 million to invest. But now, JEPI is a sub fund which is a part of that elite fund. I think it was called JEPIX. It's part of that fund, and now it's available for the common people as well. So that was a brief overview of JEPI. Let's dive into how they achieve this goal of providing a monthly dividend income while also giving out the growth as comparable to the S&P 500. 80% of JEPI is invested in growing dividend stocks. For example, Intuit, which is one of the biggest holdings, Microsoft, Accenture, Google, Eli Lilly, Target, Costco. Intuit, which is the owner of Credit Karma, QuickBooks, Mint, TurboTax, Microsoft, Google. So all these are very common names. These are high flying growth stocks. Tech companies today, they promise a lot of growth in the portfolio. And some of these, like Accenture or Intuit, they also pay out a moderate amount of dividend. Not a whole lot of dividend, but a moderate amount of dividend. That is where the growth in, and a moderate amount of dividend income in the portfolio comes from this 80% of investment. The other 20% of JEPI is invested in ELNs. ELNs are equity linked notes. Now, these ELNs are the main source of the monthly income that is being paid out. Equity linked notes for JEPI are basically contracts between two people, and the value of the contract is maintained by the assets owned in the contract, which in this case is the holdings that JEPI owns. In layman terms, JEPI is using covered calls against its own portfolio, and by covered calls, I mean the downside is limited, but also the upside is limited. And the more volatile the market is, the more money the portfolio makes. So it is using those covered calls to pay the monthly dividend income. The benefit of that is you do not lose your principal if the market falls down. The benefit of investing in ELNs with such type of contracts is you do not lose your principal. So your principal is safe, but the upside is also limited. As the market grows, you don't get too much payouts, you don't get too much growth in the portfolio. Some of the risks associated with JEPI are the risk with equity linked notes risk. They are not very liquid. It is very hard to cash them out if the market goes down by a huge amount. Also, the fund is fairly new. It just started last year, so they don't have a lot of track. They don't have a lot of history based on which we can judge their performance. Now let's look at the performance. Since inception, which is May 2020, if you invested $10,000 in JEPI, it would be equal to $13,565. That is a return of 36% on your money. Within 1 year. That is a great performance, but we also have to realize that the market has been on an uptrend in the past year. It is a straight bull market, so it is easy to achieve this return. The real test will be when the market tumbles, so the market is in a bear market, what return this portfolio will generate. If you invested $10,000, you can expect, based on the dividend yield that's been in the past year, a yearly income of around $700 based on the fluctuations in the market, a little bit more, a little bit less. But $700 is a round figure that you can get every year from a $10,000 invested into JEPI. Moving on to my portfolio, currently I hold about 122 stocks of JEPI, and so far within the past 5 months, I'm up by almost 14%. The dividend yield on an average that it has paid me out is 7%. And on an investment of $7,000, it has given me out approximately $35 to $40 every month. So over the past 5 months, I have made around $200 from a $7,000 investment. In the course of a year, it comes out to be around $450 to $480. So if you invest $7,000, you can expect $450 to $480 per year from that investment. If you invest $10,000, you can expect a $700 $700 yearly income from that investment. If you invest $100,000, you can expect 7,000, and for $1 million, you can expect $70,000 a year, which is for me personally, that's financial independence. So that's a great amount of income that this ETF pays out. This covered call ETF pays out. It is much better than its peers because it is less expensive. The expense ratio is just 0.35%. And also, it is from JP Morgan. So it's a big brand. They got a brand to maintain, and the active managed ETF portfolio managers, they have a lot of experience. In those ways, it is much better than its peers. So that was my analysis of JEPI and how much I own in my portfolio and how much income it's generating for me and what it does on a general basis. If you like this type of content, leave me a like and subscribe to the channel. This is the Frugal Investor signing out.